Good evening. I'm Sarah Collins. If you're like most American homeowners watching this right now, you likely had a moment of quiet sticker shock in the last 6 months. You opened a standard-looking envelope from your home insurance provider, expecting the usual marginal increase. Instead, you saw a number that didn't seem to belong to your property. A 15% hike. A 20% hike. In some states, a 40% jump or a notice of non-renewal entirely. You haven't filed a claim in a decade. You haven't remodeled. Your neighborhood hasn't changed. So why is the cost of protecting your most significant asset, your home, suddenly behaving like a volatile tech stock? Tonight, we are going beyond the local weather report. We're moving past the sensationalist headlines and looking at the cold, hard mechanics of global capital.
There is a quiet, tectonic shift happening in the world's financial capitals, London, Zurich, and Bermuda, that is effectively draining home equity from the American middle class. We call it the insurance cliff. Tonight, we map the world to protect your kitchen table. Let's begin. To understand why your bill went up, we have to stop looking at your local agent's office and start looking at the insurers of the insurers. This is the world of reinsurance. Most homeowners view insurance as a local contract. You pay a company in Illinois or Texas and they cover your roof. But no insurance company is an island. If a massive hurricane hits the coast or a wildfire levels a county, your local insurer cannot foot a billion-dollar bill alone. They would go insolvent. To prevent this, they buy their own insurance. Reinsurance is a global pool of capital. When you pay your premium, a portion of that money is bundled and sent to global giants like Swiss Re, Munich Re, or Lloyd's of London. These firms don't care about your specific zip code. They care about global systemic risk. In the late 20th century, this system was predictable. Risk was diversified. A flood in Germany was balanced by a quiet season in the Caribbean. But in the last 5 years, the diversification benefit has vanished. We've entered an era of secondary perils. It's no longer just about the big one, the massive Category 5 hurricane. It's the cumulative death by 1,000 cuts, severe convective storms in the Midwest, unprecedented hail in North Texas, and gray swan floods in Vermont. When a typhoon hits Tokyo or a record-breaking heat wave causes massive crop failure in Europe, the global reinsurance pool shrinks. To replenish their reserves and satisfy their shareholders, these global firms raise their rates. They don't just raise them for the Japanese or the Germans, they raise them for the entire pool. On January 1st, 2023, a date known in the industry as 1/1, the reinsurance market underwent its most violent correction in 20 years. After years of absorbing losses, the big reinsurers decided they were done subsidizing American risk. They hiked the rates they charged to local U.S. carriers by 30% to 100% in some regions. Because your local insurer is required by state law to remain solvent, they have no choice but to pass those costs directly to you. Your premium hike isn't just paying for your neighbor's new roof, it's paying to recapitalize the global financial system after half a decade of worldwide catastrophes. Historically, we've seen this before, but never at this scale. After Hurricane Andrew in 1992, the insurance market in Florida collapsed, but Andrew was a localized event. What we are seeing now is a global synchronized repricing. From 1980 to 2000, the world averaged roughly $30 billion in insured losses per year. In the last decade, we have consistently cleared $100 billion. The buffer in the global financial system has been eroded. We are now living in a pay-as-you-go risk environment, and the bill is arriving at your kitchen table. Now, let's talk about why this matters for your net worth. Most Americans have the vast majority of their wealth tied up in home equity. We've been taught that real estate is the safe play. But that safety relies on a hidden pillar: insurability. The insurance cliff is the point at which the cost of insurance becomes so high or the availability becomes so low that it fundamentally breaks the math of home ownership. Think about the mechanics of a home sale. Almost every home in America is purchased with a mortgage. To get a mortgage, the bank requires proof of insurance. If a property is uninsurable, or if the insurance costs $1,500 a month, equivalent to a second mortgage payment, the pool of eligible buyers for that home shrinks to zero. When you cannot insure a home, you cannot finance a home. When you cannot finance a home, you cannot sell a home to 95% of the population. At that moment, the market value of your house, that number you see on Zillow, evaporates. Florida is the canary in the coal mine. We are seeing homes that were worth $600,000 3 years ago sitting on the market despite price cuts. Why? Because the prospective buyer gets a quote for $12,000 a year in insurance. That extra $1,000 a month in carry cost prices out the middle-class family that would have bought it. The result is a silent devaluation. In California, we're seeing a different version of the cliff. Major carriers like State Farm and Allstate have simply stopped writing new policies in the state. This forces homeowners into the FAIR Plan, a state-mandated pool. While this keeps the cliff from becoming an immediate drop-off, it creates a zombie housing market. You are risk-locked. Perhaps most surprising is the Midwest. For years, investors fled the coasts for the stability of the Heartland. But Iowa, Minnesota, and South Dakota are seeing some of the fastest rising premiums in the country. Severe convective storms, including hail and straight-line winds, are now causing more cumulative damage than major hurricanes. If you live in a hail alley, your roof is no longer an asset. To an insurance company, it's a liability waiting to happen every spring. For the 40 to 65 demographic, this is a retirement crisis. If you plan to downsize in 5 years and use your home equity to fund your retirement, a 20% drop in home value due to insurance friction is a catastrophic loss. Furthermore, we are seeing the rise of insurance deserts, entire counties where no private company will write a policy. In these areas, the only option is the state-backed insurer of last resort. These plans are often twice as expensive and provide half the coverage. When a neighborhood enters an insurance desert, the local economy begins to bleed. Property taxes fall as valuations drop, leading to worse schools and crumbling infrastructure. The cliff doesn't just claim your house, it claims your community. I don't tell you this to cause panic. I tell you this because as an analyst, I know that the person with the most information wins. If you are staring at the insurance cliff, you need a strategy. You need financial self-defense. In the old world, a beautiful home had mature trees overhanging the roof and a wraparound wooden deck. In the new insurance cliff world, that's a liability. To lower your risk profile and your premium, you must harden your home. This means the 5-foot rule: clear all flammable vegetation within 5 feet of your foundation. It means Class A roofing. When it's time to replace your roof, use impact-resistant shingles. Many insurers offer a permanent 10 to 20% discount for these. Ensure your roof deck is sealed. It can be the difference between a minor repair and a total loss. If you've been dropped by your standard carrier, your agent might mention surplus lines. Standard insurers are admitted, meaning the state regulates their rates. Surplus lines, like Lloyd's of London, are non-admitted. They are more expensive, but they are often the only way to get high-quality coverage for a high-risk property. Don't reflexively say no. It may be the bridge that keeps your home sellable until the market stabilizes. Stop asking your agent, "Why is it so expensive?" Instead, ask 3 tactical questions. First, what is my loss-cost ratio for this zip code? This shows them you understand that the price is driven by regional data. Second, what specific mitigation credits are available in this state? Every state has mandated discounts for things like wind shutters or smoke sensors. Third, can we look at a high deductible strategy with a supplemental parametric policy? You take a high deductible to drop your premium, then buy a separate small policy that pays out automatically if a certain wind speed or flood level is hit, regardless of damage. It covers your deductible. Finally, If you are looking to buy an investment property, do not wait for the inspection to check insurance. Call an independent broker before you even make an offer. If the quote comes back at market restricted, walk away. No matter how good the kitchen looks, you cannot fight the global reinsurance market. The insurance cliff is not a temporary glitch in the system. It is the system finally pricing in the true cost of global volatility. For 12 years, I've analyzed coups, currency collapses, and trade wars. But the most important geopolitics are the ones that happen in your backyard. When the banks in Zurich move their decimal points, the value of your home in Ohio or Arizona moves with them. My mission at Insight with Sarah is to give you the map. We can't stop the storm, and we can't force the global reinsurers to lower their rates. But we can understand the mechanics. We can harden our homes, protect our equity, and make decisions based on reality rather than nostalgia. Your home is more than a line item on a spreadsheet. It's where your life happens. It's the kitchen table we are trying to protect. Check your latest bill, call your agent, and start looking at your home not just as a place to live, but as a risk that needs to be managed with professional precision. I'm Sarah Collins. Thank you for your trust, and I'll see you in the next briefing.